range, and then entering on the retest of the fair value gap. So you are literally setting a limit order at the retest of the fair value gap here. So that's kind of the nice thing, because before, what we were doing is we would just enter on the 5-minute break, and look how far up this is. This is 20 points, 25 points higher than the opening range. So even if it came and test the opening range, you're 20 to 30 points in drawdown before it even comes to the upside. So then if it fails, then your stop loss is usually 30 to 40 points. And so if we were just to use the same stop loss here and had it gone up there, we would have only gotten a 0.5, and we would have had a 50-point stop loss almost. So we're waiting for that fair value gap retest. And it's really nice because we're literally just setting limits on the fair value gap. And then if it hits it, it hits it. And if it doesn't, it doesn't. And so it's a lot more kind of patient. You're really waiting for that to come down. And what we did today was we waited for the 5-minute candle close, which if you were looking at a 1-minute chart, so these numbers right here that you see on the screen at the bottom for the candle closes of the time of the candle, those are the times the candles actually open, not close. And so the 644 candle, that's closes at 645. And so you go look for this candle closes right here. So that's a 5-minute candle close. And it right after the 5-minute candle close, it retested the 1-minute fair value gap before the 5-minute fair value gap had even been created. And so since it did that, we were able to enter with half a position on this first retest right here. And so this was the specific retest I'm talking about, this one right here. And then it retested it again and created a 5-minute fair value gap and created and retested the 5-minute fair value gap. So you could use either one. The 5-minute fair value gap obviously is going to be a little bit more consistent. The 1-minute fair value gap is going to have a little bit more shakeouts, but if it's fast and it may not get the 5-minute fair value gap, if it just ripped up from here, then you would have at least gotten into the trade and you wouldn't have had to miss the trade. And so that's kind of the differences of how you can use a 5-minute versus a 1-minute. And that's the only difference between the kind of displaced orb that we're using now versus the orb that we used to use. And now, if it doesn't create a fair value gap, then you're not getting into the trade. And that's really, really helpful because it needs fair value gaps for displacement. Fair value gaps show continuation. And so that's kind of one thing that we look for, is that's helping with the continuation. Yes, these are recorded. So what we're doing now is we're doing a fixed 1 to 2R risk to reward ratio. So as we are doing the kind of the new orb that we're doing, we're setting our stops here, and we're doing a fixed 1 to 2 risk to reward ratio. At that point, that gives more consistency. So what we kind of are learning and really kind of going to be the things that we look for and learn how to kind of modify is how to get more out of it. Because sometimes what we see, and I studied this for all of September for the last hour before we started doing this. So let me go to a 5-minute. And so no, we're not using standard deviations. We're literally just whatever the stop loss is, you're just doing a 1 to 2 based off of the stop loss. And so if the stop loss is 15 points, then your target is 30 points. So right here, the stop loss was 23 points, roughly 25. So your target was roughly 50 points. And so it's just based off of the actual stop loss. So it's just a fixed reward, risk reward based off of the stop loss itself. So now you can, so what we see here is sometimes it works really well where it goes to your, here's your risk reward, your 2R. And then other times it can blast off and go 3 to 4R. Here's your 2R here. This one went all the way down to 7R. Here's your 2R here. This one went down to 5R. So you're leaving a little bit on the table. And that's where your fixed risk to reward can kind of hurt you. It's an opportunity cost to a point. So we're gonna go a little bit deeper, and I have a mirror link that I made over. Sometimes it does work, sometimes it doesn't work. As you can see here, the one standard deviation would have barely missed. Your entry would have been here. Your one standard deviation barely missed. So if you had like a fixed risk reward at the one standard deviation, you may have not actually gotten to that full target. So fixed risk reward versus dynamic risk reward. Your dynamic risk to reward is going to be kind of looking for liquidity levels, standard deviations, and trailing stops, while usually using fair value gaps. You can use fair value gaps, you can use price weighting, and then you can also use EMAs. Usually, like a 10 EMA on a 5-minute chart is really, really good for trailing stop loss in a trending environment. I can show you right here. And let's look at this move right here. This is probably picture perfect. A 10 EMA right there. It would have gotten you out right here and gotten about a 3R. So 10 or 21 EMA, something like that. And so those are different kinds of trailing stop losses. And those are what you're using for a dynamic risk reward. For that, you're going to get, it's a little bit more advanced. So you have to be looking a little bit more at the higher time frame, understanding where fair value gaps are on a higher time frame. You have to understand what your higher time frame trend and drawn liquidity are. It has a lot more of a potential to have big winners. Trend days, like I showed you guys, they're going to get a lot big winners, and you can may be able to get 2, 3, 4R. It's going to be a lot more flexible in different market environments when you have a dynamic risk reward. In something like that, like a really choppy environment, you may be looking for a 2-to-1, and then it gets to a 1.5, and then it reverses and tags you out at stop loss. Because a lot of times with our fixed risk reward, we do not use a break even. And so it has a little bit more flexibility with a trailing or dynamic stop loss. Obviously, due to that, it's going to be more discretionary. So you're going to have more knowledge and experience in the market, and you're going to kind of have to learn how to use it a little better. There's going to be times where it works really well. There's going to be times where it doesn't work really well. It's not going to be kind of that paint by numbers that you get with a fixed risk reward. With a fixed risk reward, it's nice. You can literally set your limit order. Once your limit order hits, you can set your stop loss, and then you can set your take profit, and then you can just walk away. You don't necessarily have to watch it as much. You can set a alert on your trading view near your take profit, and then when your alert comes off, you come and check your phone or whatever your broker is on, and then see what it's at. So it's a lot easier with a fixed risk reward versus your dynamic risk reward sometimes, especially with newer people when they're first learning. They don't fully know fair value gaps. They're a little bit more emotional. They don't fully know liquidity levels that you might go to. So that's where you get a little bit better with the fixed risk reward. What's up, Brulism? Nice. So those are some of the cons. It's a little bit more advanced. It's going to require practice. It's going to work well sometimes. It's going to fail. You're going to have to just kind of refine it over and over. It's going to have more psychological challenges. You're going to have more emotional kind of ups and downs with a dynamic risk to reward, especially when you're starting. You're going to have to hold through retracements, and those retracements, even in bear markets, those retracements are going to be 50 to 60 to 100 points. In bull markets, those retracements could be anywhere from 20 to 30 to 40 points. And bull markets always have smaller retracements. It's harder to backtest when you have a dynamic risk reward, because you don't have consistency. You don't have something that, okay, I'm going to do 2-to-1 every single time. You can find something, but then it's not quite dynamic. And then when it does not work, that's when it's going to kind of hurt you, because you might go from a 2R and then looking to try to continue higher, and then it might stop you out at break even or a 1.5R really, really fucking fast, like today. If you didn't have a fixed 2R stop loss already set in place, what in the fuck did I just do? If you didn't have a fixed 2-to-1 stop loss set in place, if you're looking at a 5-minute, you might have you had 15, 20 minutes to be able to get out of this. And if you weren't paying fully attention, you could have gotten out of this at a break even or at a stop loss real fucking quick. Somewhere right around here, here's your 2R. Within 2 minutes, it was back down to a 1. And then it came back up to about a 1.9. And then within 30, 15, 20 more minutes, it's back down to a 1 or less. And so that's where when you have that dynamic with a fixed risk reward, you set your take profit and then it hits it and you're cool. Doesn't matter. With a dynamic, those wicks like that, it might wick off of it and you may not have that chance to take your profit because it's too fast. So those are some of the pros and cons of kind of a dynamic. With a fixed reward, that's just set based on your stop loss, like I was mentioning earlier. Usually what we're looking for is between a 1.5 to a 3R. 2R is kind of average, what usually people are looking for. With our displaced orb model, what we've been doing is right at that 2R for our fixed risk to reward. Those are very nice because you can set your limit order like I was mentioning. Literally just set your limit order at 2R and then walk away. Those are consistent base hits. It's really nice because when you're a beginner, especially when you're a beginner, you don't necessarily care about catching all these moves, ups and downs, this whole move here, these whole moves here. When you're a beginner, you really want to just catch consistent moves over and over and over and over and over and over and over. It doesn't matter if you're going to catch 100-point moves, 200-point moves, but if you can catch 80, 80, 80, 80 over and over and over and over and over, that's what's going to build confidence and it's going to build consistency. It's going to help you build data as well because you're going to take more trades and you're just going to continue to take them and continue to stack. With your dynamic, you're going to probably going to hit more. You're going to have to move your break even a little bit more. So you're going to get stops at break even more. So each person is going to have to kind of determine what they want to look to do. And sometimes you can do things like take most of your profits off at a fixed risk reward, take 90% of your trims off at 2R, and then let one contract run and see how long it can run. Some things like that. That's very, very easy, very normal you can do. Like I said, some of the cons on a fixed risk reward, the market is going to run without you some days, not most days, but some days the market is going to run without you. It may not hit the target in reverse, kind of in choppy markets. And then again, it doesn't adapt to market conditions. So in a trending market, it's not going to work. It's not going to work as well because it's going to leave a lot of opportunity cost. I didn't like that. Delete that. Whatever. So right here, you can see the kind of win rate of how much R you're looking for, and then what you're looking for your win rate. We know that the displaced orb has roughly a 45 to 55% win rate. We're just going to use a rough estimate. We know it's right around that 50% though. So if we just use a fixed 2-to-1 risk to reward, we know that we are going to profit from this day. So what we were looking at on our studies over the weekend, from what I've been studying, is how many days of the week is it likely to work. So most of the time, it works 3 days out of the week. And so that can kind of tell you also that if you were to go on a Thursday and it's already worked 3 days out of the week, then you are less likely to continue. Or if it's a Friday and you already have your 3 wins for the week for 3 different days, then you can say, oh, hey, you know what? This is less likely to work. I'm just going to take the day off and skip a higher probability loss. Sometimes it might play out, sometimes it might not. And so that's something that you can kind of study as well as you're really studying these models. And so as we're learning, we're just kind of refining more and more into it, learning what the different patterns are and things like that. Does this make sense for everybody? Piece of the pie is all you want. Exactly, Gar. And they say there's a really good saying that I love in the market is bulls get paid, bears get paid, pigs get slaughtered. And so that just means that if you're looking to be greedy, if you're over trying to over target, then you're just gonna get slaughtered. Once you're consistent and you stay humble, that's gonna continuously help you make money. So actually, we just like the 1 to 2 R rather than moving stops at break even at 1 R. I think it would work better to just leave the 1 to 2 than setting stops at break even at 1 R, because how many times is it going to set stops to is it going to hit your break even and then play out? And so even like right here, say yours this hit a 1 R right here, and then it hit stops at break even, and then it eventually ended up actually playing out. And today, actually, you're exactly right. It would have happened today. And so I think you know what you're gonna lose. If you take the loss, you know what you're gonna lose. So when you get in a trade, you know, okay, I'm losing 1 R. You already know you have a limit order on exactly where you're going to get in. That's the beauty of this. So you know, okay, I'm going to get in exactly at this level. My stop loss is going to be exactly this level. And so you can make it really easy and consistent with, okay, if I lose, I'm going to lose exactly 1 R. All right, cool. If I lose it, that's no big deal, because we know from the data that we've collected that that over the period of a long period of time, it's going to be profitable. And so if you're just losing 1 R, not a big deal. Are you checking these in normal stocks as well, or main focus is index? Right now, their main focus is index. But from my studies and previous studies and knowing the opening range break, absolutely, you can use this in normal stocks as well, Nick, especially with the way you trade. The way you trade is you really focus on like stocks that are going to be moving for that specific day. You do a good job at finding stocks that are moving for that day. QQQ, perfect stock, perfect one to try it with, Gar. I agree. And so you want to make sure that it's going to be a stock that's in play for the day. So if it's not in play for by in play, that means it's going to move. If it's not going to move, if it's just going to go sideways for the day, then there's no point. And so if you want to do stocks, you want to make sure, and that's the beauty of stocks versus the QQQ or the NASDAQ or the ES is there's more options. And so you can say, okay, this stock it doesn't have a very good volume today. And so, this stock has a really low range for the day. So I'm not going to trade the opening range break on this stock today. This other stock, like today with Restoration Hardware and Williams Sonoma for Nick, these stocks are probably going to have a larger range for the day. They have news going on. So let's look at these stocks more. And then you can use that same opening range break, that same model that we use on those stocks as well. I did that today with a QQQ, bought $2 out the money and went 60%. Beautiful. Yeah, Gino, that's awesome. And so this is the beauty of the model itself, is all it needs is volume. That's the key thing that it needs, is it needs the stock to be able to have a good ATR and a good volume. It needs to be able to move for the day. And so that's where you're not going to want to try this on like a $2 stock or a $5 stock, something like that, because they may only move half a like 50 cents, something like that. That's just going to be ridiculous, and it's not going to be worth your time. That's why a lot of times we just focus it on indices. And any time that we trade it with NASDAQ, you can absolutely, absolutely, absolutely buy QQQ options for it. You can do $2 out the money or right at the money and just buy like same like weekly QQQ options, and it's going to work out. If the orb works out for NASDAQ, it's going to work out for you QQQ options. And so that's another way that you can trade the orb. That's the kind of the beauty of it, is there's multiple different ways. You can use 1 minute, you can use 5 minute. The way when I do my back testing and my studying, I usually study more on a 5 minute. And so I really, really, really like the way the 5 minute looks. So I went back and I back tested all of September's opening range breaks. And this is where I'm kind of studying on when we can extend our targets. And so I'm back tested all of September's opening range breaks. And as you can see here, I have all the fibs for every single one. That worked. And so it worked roughly. Let me go. I have Ty's thing pulled up here. It worked. I'm not going to include the first because it was only a 1R at 1, 2, 3, 4, 5, 6, 7, 8, 9 times. So it worked 9 times. And so if you just go to Ty's displacement orb, I'll share the link for this real quick so for those that want to see. This is Ty's journal. And this is just his backtesting journal that I'm using. He's collecting the data and I'm just analyzing the shit out of it. And so out of those 9 times that the opening range break worked in September, I'm looking at almost every single time. I think there was 3 times where when it did work, that it didn't go to one standard deviation. And so that's something that I'm continuously and consistently looking at is when we're looking, if we can target right around that one to standard deviation, sometimes it adds a little bit of adds some risk to reward. Other times it doesn't add anything. And that's kind of where it might work sometimes and give you an extra 1R, might give you an extra 2R. Then other times it might just give you an extra 0.5 like this one, 2.57. But it continued a lot further. And this one again. And this is just a bare minimum. And so this is where you can use, okay, well, bare minimum, I might be looking for one right around that one standard deviation. This one here is one standard deviation, is right at 2.3R. And so notice even almost everyone in this one was difficult to, like, this is where back testing is really interesting because this got, it got 4 points away, if that, from one standard deviation. Here would have been your entry. So we got about 4 points away from one standard deviation. And it really just depends like how tight you have this, how if you have it on a magnet or not, so that could be where it's okay, well, that may have worked and it might not have worked. And then some of these did not work at all. So again, this one did not. This one was Powell speaking right here, 2.67, going to that one standard deviation. So more often than not, this is a 3.8. You see them coming to that one standard deviation. But if it fails and you get your 2R and then it fails to get back to the one standard deviation, you may end up having to close some of it or all of it at a much lower risk to reward. So there is kind of every gimme has a gotcha. Everything that's good has some bad to it. There's something that you might have to go with it and to look into. You're gonna have, if it doesn't work, that 2R that you would normally just close out at, and oh hey, I'm looking to extend today, but now it does not extend. Now I might end up closing at a 1.5 or a 1.25, and that could hurt your risk to reward in the long run. And so I think a lot of the key things again would be just the normal things that we look for: clear drawn liquidity, displacement, fair value gaps. Is it creating fair value gaps on a 15-minute, on a 5-minute frame? Is it displacing below lows? How is it reacting when it gets to these lows? And so a lot of different things like that will help determine whether you want to extend, because sometimes like a 3.8 instead of a 2R, that's nice. That adds an extra 1.8R onto it. So if you take a loss on another one, or if you go back to 1R on another one instead of 2R, it already makes up for it. This one goes exactly to 1R. I don't even think it created a fair value gap. It was Powell speaking this day and Trump, but it ended up going to 1R or one standard deviation. So you can see a lot of these in this one. It ended up, I think this was a failed move. Oh, this was, yeah, here is Powell speaking. You can see, and I don't even know where the before was on this. And then other times like this, where I even think this moved to 1 standard deviation. Yeah, this was the one where I was showing it where it barely did. So those are different ways where we can look for continuing and extending moves, and especially for expansion days when they have clear targets. When the market's just going sideways and you see these EMAs like right here, especially this 5 minute, when you see this 5 minute EMA really just going sideways, really tight price action overnight. Like look at this overnight range all night. Here was the open right here. Here's your overnight open. Here's your essentially when you open for New York. This was all within, and let's say besides this news, this was all within 100 points. That's incredibly small range for an overnight range. And so when you do see these overnight ranges really, really small like that, you see this 5 minute 200 EMA just going sideways, then that's kind of a good idea that, hey, this might just be a little choppier right now until you get some sort of confirmation above or below or a direction of that moving average. Notice it started pushing up. Usually it's going to push down. It's going to move back up to the upside because we are in a higher time frame uptrend. So if it starts going sideways, then it ends up going back to the upside. I think I hear my daughter. Any questions on that? Hmm. So this is where we can really kind of when we get a bot. Ty was saying that he's got people working with the bot. The bots can have a good they'll be able to do a lot of this back testing and like figuring things like this out a lot more and a lot quicker than just doing it manual like this. Doing it manual will always add your confidence though. So when you look at Ty's data in the opening range for the displacement of what he did and how he looks at it, you're not going to get the same confidence in the model as if you do it yourself. If you run a program that does the data, is not going to give you the same confidence of you going and looking and marking out every single one yourself. And I think that adds so much too, because when you do, you recognize you see some of these patterns, you recognize some of like what the market looks like for each time, and you can really make sure that you kind of build that pattern recognition instead of just going and looking at throughout a trading view screenshot of what happened and boom, this is it, this is it, this is it. You can go and you can do the back test, go on the replay mode. And when you do it, do just like Ty did, get one of our journals and then get a brand new journal for yourself and then start filling it out instead of just randomly doing replay mode and just doing it boom, 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 boom. Start filling out every little thing that you're doing. Start filling it so that way you can find patterns. And that's how I started finding the patterns of, okay, this is likely to work 3 days a week. If you see 4 days a week, it might work. There was, since Ty has January and February now, it worked more often in January and February than it did in July, August, September. So in July, August, September, 4 days a week has only worked twice. In January and February, 4 days a week worked 3 times between the 2 months themselves. And so that's where we can kind of start seeing a lot of these patterns, and that helps you really understand the model itself. Then the whole key is we have our model, you stay with the one model, you ignore everything else, you stop over trading, and then that's going to help you build that consistency. A lot of over trading comes from looking at multiple models, looking at multiple different aspects. Yes, we have our ILM. What do we look for in ILM? Well, if we get some sort of push to a certain direction, usually the downside, and then a failed opening range, then a lot of times we end up getting an ILM. Is it guaranteed? No. Last on Friday, if we would have put our stops at the lows here, we would have gotten about a 1.3R, but it would have worked. So sometimes it's not even worth it. Today, once you failed your opening range, fair value gap right here, you immediately inverted, and then you ended up going to the bottom of the orb range. So there was a trade. Sometimes it works, sometimes it doesn't. Do you think it has to do with the way the weekly candle is built, accumulation, manipulation, distribution? I think so. Yes. For the number of times it works throughout the week. Yes. Absolutely, MG. And that's perfect. Every single week is going to have at least a couple days where it's not going to do anything. It's just very normal. And I think it also not only has to do with that, but I also think it's going to have a lot to do with where you are in a higher time frame trend. Everything is in kind of context with all of your frames. So you have to have that really full frame alignment to really give it that to understand, okay, this is when it's going to work for this specific day. Let's say, and from this is one couple of things that I'm studying is let's say that it's only worked on a Monday and a Tuesday, and now you're on a Thursday or Friday. How often is that Thursday or Friday going to give you at least one trade where you've only worked 2 days a week, and now you're is it most likely going to give you another trade that week? And a lot of times, yes. If you are coming into Thursday or Friday and you will only have one, maybe two trades for the week, yes, you are a higher probability to give you that trade, another trade for that week. So you can say, okay, well, that's more likely to play out today. SMT was why I wasn't confident for the move up, and that's perfect. That's a great kind of way to use that your multiple confluences. Those are the layers instead of just a lot of people just want that. Give me that base model. All I want is the model. I'm going to follow the exact model every single time. And that and it does work. Obviously, we've seen it. It does work, but you're going to add a lot more when you kind of can use your discretion. Discretion trading, it comes with a lot of experience. You have to have experience. You have to know SMT. You have to know when to look for SMT. You have to understand the accumulation, manipulation, distribution. You have to understand where fair value gaps are. You have to understand higher time frames. And that's where your you're going to need to gain experience, and that's why it's difficult for a lot of beginners when you're first starting and when you're not consistent. The extra discretion adds extra emotion naturally because you are using your opinion. So your ego is going to be in there more. Since you're using your opinion and kind of based off of different experiences that you've had, your ego is going to be into the trade a little bit more because you're going to want to be right. Your ego is going to tell you, hey, this is something that I need to be right on because that's what your ego does. Have you done any studies on wick size? For example, we barely have a wick down on a weekly for this week. Would you say it's fair to assume that we would create a new weekly low in the upcoming days? I don't usually put that in, but yes, that's definitely something you can put in. Like, this is actually perfect. This week could definitely pull back somewhere down here. This previous week low would be very normal. We have a fair value gap right below that right here. And we're already kind of already have a top wick. We could do a bottom wick and then close somewhere in the same area. It wouldn't surprise me. We don't have a lot of news this week except for NFP. So it wouldn't surprise me if we were just had some sort of like an inside week or just a smaller kind of an upside reversal week where we take out the lows and then close somewhere towards the highs because we had NFP on Friday. And that's another one I want to study is how often does it work with NFP days? That's another thing that we can study as we are learning about the opening range, the new kind of displaced opening range, as we're kind of getting our back testing. I don't necessarily do a lot of studies on the wick size of itself, but yes, I'm consistently looking at what can the weekly candle do, what is the daily candle most likely to do. At the end of yesterday, or Friday, being yesterday. At the end of the day on Friday, it was pretty easy to say Monday is probably going to be some sort of up day. We're going to have some sort of move to the upside if we can break above this high. And that's exactly what, unfortunately, it was overnight. Of course, like a market likes to do things that are we don't really like, but you're constantly when you get these pushed down, notice there's no fair value gaps created on this daily chart. Every single day that's a down day is closing towards its highs. You get a heavy candle, a smaller candle with a heavier wick, a smaller candle with a even heavier wick. So you're seeing clear failure to displace to the downside. You're right inside a daily fair value gap here. So that was a really clear sign that, okay, we might be continuing to the upside at least for the day. Now we have kind of a base that we're starting to build out. We have a fair value up here, which we are entered into. So if we can hold here, then we can look to continue back up to these highs because now we've created a higher low. If we can hold here or somewhere around here, this whole kind of area above this what is this 24675, somewhere above here, we can create a higher low. And then we can look for, since we have a higher low, now we can continuously look for this high up here, this all-time high. And then if it starts failing, then we can look for what it's going to do next. Well, if it fails this fair value gap and fails these kind of inverted fair value gaps, inverted fair value gaps here, these right there, then we'll see how it reacts to the daily. If it fails that, then we'll see where it takes this low. And that's going to give us that weekly fair value gap. So on a day-to-day basis, I'm really looking on what's it done overnight, where's it at on a higher time frame, 60-minute, 4-hour time frame, and then where is it likely to go? What do we have on a 60-minute here? We have a market structure shift here. This looks like a market maker model to the upside, in my opinion. We got equal highs right up here. So once we invert this fair value gap, we can start looking to the upside. If we create more fair value gaps as we come down here, we can look for those to get inverted first. And then this one won't even matter. That's a lot of how I'm reading the market. Is I'm looking, it's from one level to another to another. As we took out this level, we didn't create any fair value gaps, but we did. It barely got in. It was very small though. But we don't want the market to just continuously blast off. That's kind of we like pauses. We want pauses in the market for the long term. Like if we look right here, this right here that we have, this angle is even steeper. This angle right here, look how steep this is. If we just go and do a trend line like that, look how steep that is. We can even get an angle degree, trend angle. Trend angle matters a lot. So it's almost a 90. Like here's a 90. It's about a 60-degree angle. The angle of the trend, the higher and steeper it is, the less it's gonna long term it's gonna be kind of sustainable. Look at this one right here. This one is at 37 degrees. And so this one wasn't as steep and it lasted almost 2 years. As it gets steeper, notice right here throughout this portion up here, 60 degrees. Oh, fuck, that's cool. Right around that 60 degrees, this one was 58. it starts pushing and then it eventually will break through. And so I'm consistently looking for kind of how is the angle of the market, of the ascent that we're in right now. Something like this, if we could start getting a trend line moving like this. We got a tap there, a tap here, a tap here, and a tap here. This would be very sustainable. I would love that. And that would match up with our theory of coming to, if we came to this fair value gap on a weekly chart for a bottom wick. That would be beautiful. So now we have a narrative. That's also a all-time high retest. So I'm really like this right here. This is another good one. Just because you have something steep, this was a super steep angle, doesn't mean you're just gonna go and you're gonna reverse. You could just go sideways. And notice this kind of just went sideways for, it didn't really, like, it was trending to the upside, but from this day right here on May 15th to June 25th, so almost 2 months, actually 2 months here, that it only went up 202%. It was very, very small move to the upside. So it may not just pull back really hard. It may just kind of trickle up and start moving very slowly to allow things to catch up. Give me 1 second. I can hear my baby waking up from her nap and she's crying. I'm going to grab her and then we'll be right back. What's up, Freaky? What was going on here? For what I'm showing on my chart. You, of course, all good. You good? All good, my G. Yes, sir. Baby just woke up. So today we were going over the differences between the dynamic and a fixed risk to reward. Was there an orb short today? Let's look. So today we were going over the differences between a dynamic and fixed risk to reward, kind of how you can do dynamic fixed reward, and then what are their pros and cons, and then fixed risk reward and what are some of the pros and cons with that. And that's really good with our new kind of displaced orb method that we're looking at right now. It's very chill. No, my daughters ask me to sometimes, and then I will if they do. I see no fair value at all on the 5 minute. Let's look at the 3 minute here. None on the 3 minute. I don't. There might have been on a 1 minute. Here's a no close. Here's a 5 minute closeout. None that worked. Maybe right here. Here's a 5 minute closeout. And I mean, this is um kind of pushing and forcing, but you get some sort of you get a 5 minute close outside of the range right here at 45. enter on the retest. Stops at the high. You got to fix 2R. So it's kind of pushing it and not the cleanest, not the greatest. Overall, 2R is usually the thing for ILMs and orbs, right? Yeah. And that's really what we're looking for is 2R. If you can get a consistent 2R every single day, that's base hits. What's up, Peggy? And consistent base hits over a long period of time, those are going to add up. They're going to add up incredibly. Especially if you're somebody where you get profits and then you give them back often. If part of one of your biggest things is, and that was part of my biggest problem in August. And that was actually why I had a really mediocre August. If you go back through all of the trades that I took in my trade journal in August, I gave back a lot of profits. I would get into profits and then try to hold it longer. And I'd get like 1.5 into 1.5 to R into profits. And then it'd stop me out at break even because I'd be trying to trying to continue it further, or it'd stop me out at like a 1.1 R or something like that. And so just continuously hitting those, if you're somebody that this happens to, where especially in these like choppier market states that we're getting, where if you're consistently getting stopped out at break even after moving 1R or moving 2R, then just set a fixed 2R and ignore break even. You almost never need to use break even and just do a fixed 2R, set your stop loss, set your take profit, and let them run. Don't extend them. Don't try. And then if it does continue, don't fucking look at it. Your ego is going to tell you, oh, you fucked up. You didn't make as much profit as you could have. And that's your ego every single day is going to tell you that and wants you to continue. But if you can be disciplined enough and say, you know what, I'm okay with missing those. Sometimes you're going to be able to make more. You're going to be able to make more. Sometimes it's going to be goddamn obvious. And it's just be like, all right, fine. Like on, what was it? This day over here, it was super obvious. Where was it? It just got rejected off of a five, off of a, man, where'd it go? It was one of these days. It was obvious that price was going to come up to the 200 EMA on the 5 minute chart. It was like, okay, well, this is 100% like going to happen. It was this day right here. Wednesday. Was it Wednesday? Thursday. Last Thursday. It was last Thursday. Oh yeah, I had jujitsu that day. And so it was obvious that it was like, okay, we're right here. I can take my profit right here. Here is a 2R. Was essentially at this high. Here's your entry. Here's your stop. It was actually your stop was a little, I had my stop a little wider. It was like 2R at this high right here. And then, or I could have held it to the 200 EMA. All right. Well, the 200 EMA was kind of an obvious place. It's like, okay, well, we have our market structure shift. We have our retest. Now we're likely going to at least come to here. If we can break here, then we continue higher. And so those are some of the times where it's like, okay, let me just extend it a little bit. And even then, this failed fairly quick. It failed within 30, 40, within an hour. It was back to almost at break even. So some days your account saying something else. Yeah, some days it's going to work and you can extend it. Other days it's not going to work and trying to extend it is only going to get you caught at break even or at a loss. So it's really up to every single individual trade, in my opinion, and each individual trader of what their determination of, hey, this is what I'm going to do. I'm going to do a consistent 2R every single time. I'm going to add one extra contract, micro contract, and I'm going to, let's say my normal lot size for is $250 risk. I'm going to add one more contract, which might bring it up to 300. Not that much difference. And I'm going to sell four, let's say it's five contracts total. I'm going to sell four of the five contracts at 2R. And that one extra contract that I got, I'm going to let ride and see if I'm going to set stops to break even. let it ride and see if I can make an extra 2R out of it, 1R out of it. That's another way you can do it. There's so many different versatile ways that you can adjust it to try to make a little bit more. And I think that's almost the best way to do it is not holding you don't want to hold your position towards that all the way up most of the time. If you're using a fixed risk reward, using just taking a little bit to that for the dynamic risk reward and then setting the rest at a risk fixed. Also, take some profits if you have trailing drawdown. Yes, if you have trailing drawdown and you're still working on that fixed risk reward, that's actually, thank you for saying that, Freaky. I'm gonna add that our to my Miro diagram here. Trailing fixed risk reward is better for trailing drawdown, in my opinion, because you know exactly how much you're going to make and when you're going to make it. You're not expecting to target, you're closing your profit at the highs every single time. And so we're going to add that on here. Fixed risk reward is better for trailing drawdown because you're closing at equity highs, closing trades at equity highs every time. Any questions on the new orb, on any sort of psychological or kind of problem that any risk management problem that anybody's been having lately? Kids should be here at any time. So perfect timing. I just struggle with contract sizing, but the tool has helped a lot. I think part of it too is if you could get kind of a range and have a range more than an exact amount, right? You know that between 20 to 30 points, you're going to have 3 contracts. Between 30 to 50 points, you're going to have 4 contracts. So that way, instead of having an exact, if it's this much, exactly this amount, I'm gonna have exactly this contract. You can kind of have a little bit of a range and say, okay, this is my range where I can get 2 contracts. This is my range where I can get 3. This is my range where I can get 4. And I think that'll really help out with the speed of determining how many contracts you need. And I definitely think that this newer opening range break, since it's not as fast with the display store, because you're setting a limit order when you see the fair value gap get created, I think that adds a little bit of kind of patience where you're able to analyze and kind of see exactly how many points the stop loss is a little quicker as well. Always just divide the stop loss by $2 amount per point and then amount by points. Yes. Yeah. There's a full like essentially like a formula that you can use, and that's pretty much it. The formula is the number of contracts equals R, and then if you divide R, so your amount that you make divided by 2 being, well, I use S being the stop loss times P being the number of points. And so that way you can use it in any amount, but this is how you essentially write the formula for what you were just saying, hard R collector. $2 is P, your stop loss amount. So you have 25 points times 25 points times 2, that's $50 per contract. $300 risk would equal 6 contracts. There's some sort of calculator module for dummies. There is Ty has the Chrome indicator that you guys can use. Let me search it in Discord real quick, and that way I'll post it in the chat here. Here's the Chrome extension link. So if you are working on contract sizing, this is the Chrome extension link that's free. Oh, my kids, you need to take care of us like your babies. I do. I do. I do. What are art collectors? That's crazy, man. That is a fire name. You guys are amazing. Any last questions? I can hear my kids getting home. This is more psychological, but the more detached you are from the charts, the more money you'll make. Absolutely. I absolutely agree. Yeah, sissies are here. Did you ever study trading cycles? Yes. I've studied lots of trading cycles, being cycles, seasonality cycles. Um, I've studied cycles in a sense of um, election year cycles. And so with election year cycles, usually you get the first year and the second year are great. The third year is has a higher probability of being a down year, and then your fourth year tends to be really good as well. So there's a lot of different trading cycles that you can look at. There's cycles with hold on, baby, okay. There's cycles with different seasons where usually you see called the best 6 months and the worst 6 months of the year, where you see November, December, January, February, March, April being the best 6 months, and then May, June, July, August, September, no, and then October being the worst 6 months of the year. And so that's just being the most likely of the market moving to the upside. So if you are interested in that, I recommend getting the book. It's called The Stock Market Almanac by Jeffrey Hirsch. And that's where you see I apologize, my dog's barking like crazy. But if you see like chauffeury, he posts a lot of seasonality and stuff like that. That's something that I showed him was the stock market almanac, and that's where he gets a lot of that. It's fantastic when it comes to seasonality. I studied a ton of it. And then if you want somebody to look up Jeffrey Hirsch on YouTube, and he has really good videos with Trader Lion and I Investors Business Daily that are really good. Where he goes a little deeper in them. Investors Business. I'm typing this out. So Jeffrey Hirsch on YouTube and Trader Line and Investors Business Daily. That's where I learned like those two um resources is where I learned a ton of kind of a lot of my basics when it comes to more fundamental knowledge in analyzing really like a higher time frame and different stocks and stuff. So those are both Traderline and Investors Business Daily are great resources. Focused on Keep the Markets by Hunter. I'll write one eventually. Right now we have these market master classes and these Monday risk managements, they give so much stinking knowledge to them that they are so the risk management classes can help so much in just keeping your head correct, keeping your mind clear. And then so speaking of, on Wednesday for our market masterclass, we're going to go over selling puts. So selling puts and options, and then selling covered calls, and running what's called the wheel strategy. So a very basic, very passive investment strategy that Robbie is doing right now. And a lot of people have asked about kind of a master class. And I know he doesn't have a ton of time for that. And so I'm just going to go over the basics of kind of how you do it and what it is. What is he doing? How's he doing it? What's it mean? What's it mean on a chart? What's it mean on the options and everything like that? How is he exiting a lot of it? How's he finding some of these? So we're going to do a deep dive into that on Wednesday. So that'll be selling puts and selling covered calls and what's called the theta wheel. So I appreciate you guys all. I got to head out though. Enjoy the rest of your day. We'll be back tomorrow for live trading. Is this recorded? Yes, this is recorded. I will get this posted as soon as we're finished. I'll post this up, and then I'll post the Miro link with it too for everybody. This Miro link that I have, it'll be for almost everything that we do, and so that'll be nice. So I don't have to. You guys don't need a million different ones. It's just gonna be one. Yep, Wednesdays will be recorded as well, every single day. All right, guys, I appreciate you so much. Thank you for joining. Thank you for your interactions, and I'll talk to you tomorrow.